Welcome back, traders. Today's lecture will be us going over how to tie all the previous videos together in order to trade this perfect entry and exit strategy. So the first thing that you want to do is pull up your naked chart. Again, a naked chart is only where you have candlesticks. You don't have any indicators other than candlesticks, because candlesticks represents price, and we are trading price action and market structure only. We don't need any other indicators other than price. Price is the best indicator that you need to trade the markets. Price and manipulation is what drives the market. Anything other than that, you're overcomplicating your charts and you're setting yourself up for failure. You only want to pay attention to what price is telling you. Price is your roadmap. So you just think of price as, a GPS system. If you've never been somewhere before, or if you've previously been somewhere before, and you want the best route to get there, or you want the route to get there not knowing how to get there previously. So price tells you that. Like a GPS system, it gives you the route. It tells you turn by turn analysis on how to get to your destination. And price also maps out your destination on your charts. So the first thing you want to do again is you completely wipe everything off your charts and you just have candlesticks. Then the next step from there is you want to go to your horizontal line tool and place on dynamic hard support and resistance. I know that I said that you don't need to use these lines because you don't refer to them as, areas of trading on your charts, because they could be, pushed through or they can fail, but we need them to help us draw out our roadmap. So we'll use them in the beginning. We will remove them. So you find your levels of support and resistance on your charts and you add those. Okay, so now once you have your levels of support and resistance, I'll actually put another one here. Let the market come down to this level twice. So now that you have added your areas of support and resistance, you want to refine these areas. So get your rectangle tool. You can make this any color that you choose to make it. I like yellow because it shows better on the charts, shows the candles and the wicks show up better through this. So once you find these areas of support and resistance, you want to, map the areas out in more detail. And actually, I'm going to show you something else with the horizontal line tool, just to give you a better area to draw in your rectangular box. So you go back to your horizontal lines and you find the wicks that have reacted off of these levels, and you come down to the bodies of the candles on top of those wicks or on the bottom of those wicks if you're looking for support. But here we're at a level of resistance. You put another horizontal line there, and then you map out your entire chart like that again. Do have a zone here, but it's a minor zone, so I won't map that out. So now that you have these zones better mapped out, actually put one here, this level, use wicks. Grab the top of these wicks. So now that you have these levels mapped out, you want to go back to your rectangular tool and add these to your charts. Now once you have these levels on your chart, you want to remove any hard support and resistance levels that you have. And I have this level here, but yeah, we'll add the level here is this as well. Sometimes you have levels right on top of each other, but that doesn't necessarily mean that you have to trade those levels. Oh, this is a minor zone level, but I wasn't going to put it at first, but we need this to map out how price reacts in this zone. So now that you have your levels mapped out, you want to remove the hard support and resistance lines from your charts because you no longer need them. Now once you've done this, you want to zoom in on your charts in order to see these zones more clearly. So we have these price action zones on our charts. And actually, I'll move this zone here up to this level here. So we had more of a swing reaction on this level. And the zone swung through here, touched the new zone. And once we broke this zone here again, we came back to the downside of that minor zone level that we had. So I like to swing trade, and this just gives me a better overall picture of the swing. So if you see we move this zone up and you have this level being tested multiple times, and then we rally back up to the upside. So once you have these levels on your charts, we're going to pretend that this is the trade area that we caught in order to show you how to use price action structure and these levels in order to set up your trades, to do your analysis on, to try to figure out what's the next probable place that the market will go to. So here we have this area here, and you see that prices come down to this area multiple times. Actually have one of the resistance lines I want to remove. Okay, you see prices came down to this area multiple times. and price has failed to go lower here at this level. So you want to get your trend line tool in order to make dynamic support and resistance lines at this level. And what you want to do is catch the low of this wick, and we'll pretend that this trade has already built this channel here. So you're looking for price to come down into a level, or push up to a level and create some type of consolidation or sideways movement or channeling in those two areas. And what you'll notice here is prices failed to break this level multiple days. We're here on the daily chart. So prices failed to break this level multiple days. You just have price channeling in between these two levels. Then here, after maybe a week of consolidation or sideways range bound movement, you have price finally breaking this level to the upside. Now, if you're a novice trader, you would think that, hey, price broke this level, let me jump in, and that should show me that the trade is going to guarantee go to the upside. And if you did that, you would be jumping into the market too early, and 9 times out of 10 you would have jumped in here and then found yourself sitting in the red and not knowing what to do. You'd be confused. Most likely you would have took a loss here. So what you want to do is always wait for price to break your mapped out area, and then for a candle to close outside of that area. Now, once this candle closes outside of the area, you want to map out the high of that area. Now that you've mapped out the high of this area here, you want to see price test this area and then pull back into your previous level. And you can see that price has done that here. Pull back in order to test this level. It didn't touch this level, but if you see, it came down and broke the area of this wick here. So now that price has pulled back to this area, as soon as price rallies up again above this new high that this wick has created here, you enter the trade. So you would take your entry here. Now you made an entry here at this level because price has previously made a new high off of this channeled support. Price broke, made a new high, pulled back, broke again, tested new structure to the left, had your pullback off of this new high level, and then that's where you're looking to enter your trade off of this retest and a momentum move to the upside. So the market retested this level here, which was left by this previous wick, retested this level. The market broke this wick here to the left. We entered the trade here. We put our stop loss below this level, a few pips below this level here. And then we hold the entry all the way to this level here for our first take profit. And then we want to wait here. If you have multiple trades in, like me, I would, I pop multiple trades in on my trades just because that's how I trade. I compound, multiple trades in one area. But I wouldn't recommend this if you're new to trading and you have a small size account, because if this, trade setup fails you, then you take multiple losses. So you put your trade in here, which is that you just put, entered one trade. You want to take your profits at this touch of this zone. That is to give you, guaranteed profit almost, because here we're trading zone to zone trading. So as soon as price breaks this new high created, you enter the market, you apply your stops below this previous level that you put on your charts, and price rallies up and touches this zone here. Now, price touches the zone, it automatically takes your profit. And then you figure out what price is going to do once it's touched this zone. Me, I would play safe and let price break this zone to the upside, find new structure as it has done here. You had price breaking your zone here. Again, you have the wick of a new high to the upside. You had the market pull back. You had the market close. You had the market rally up to new structure, which was previous structure to the left. Then the market gave you your second pullback, and the market pulled back right to the bottom of your zone, created support off of this resistance level. You had a bounce here. When the market broke your previous high here, or to be safe, your previous high here, you enter the trade. Me, I like to try to get a faster entry, so I would have got my entry here. You can see that we did have a minor pullback here, but stops would have been below this area here. Then the market then pulled back up on this daily candle, and then we rallied to the upside to take profit at this zone level here. And you just repeat this over and over again on your charts. All you're looking for a market to do is come down into support or resistance. Create that on one of your zones. Either stall out at support on a zone and then give you a signal that the market is going to rally to the upside, or break a zone and give you the signal that the market is going to continue to the upside. Or like here, the market rallied up to the zone. The market tested the high of this zone. The market then pulled back, and now you have the channeled structure. 3 days worth of channeling. The market broke this level here. The channel pulled back into this level, and then the market then broke out of this level and closed below this new low that this week created. Once the market closed here, you had another candle here, open here, pushed down to the downside and left this wick. Once the market pushed up here, I would enter the market here once this candle body traded below this previous wick here. So I made my entry here. The market then broke this level and continued to push down, and your take profits were again at this zone. Then if you see that this zone was respected again, you got a few days worth of channeling. The market broke out here, pulled back into your zone. The market broke here. As soon as the market broke this level of a new high made from this zone area, these few days of channeling, I would enter the trade. The market then rallied to the upside, and you took profit. You took profits again at this zone. So it's as simple as that. This strategy is just looking at market structure, previous structure that was left on your charts, and using that structure to be broken, price to rally, to make new highs from that broken structure. You wait till the market pulls back into that structure area and then breaks that previous wick high or the previous high that the market printed after, your structure level was broken. I like to enter on the breaks of the wicks, like here, because it gives me more room to rally to the upside. If you would have waited for the market to break here, then you would have got just 1 day's worth of movement to take profits. Here, I broke this previous structure break for the second time. The market pulled back below this area. Market then rallied up, tested this area again here. Then we broke this area for a second time, and I entered at the break of this wick, which was here. And I had multiple days to rally to the upside. So you can trade this however you want to trade it. You can, take a faster entry and trade here, or you can take a more safe entry and trade at this level and still collect a nice profit to the upside. And the same thing with your downward movement. You could let the structure be broken here, take your entry here. Once this level is broken again, or you can wait until this wick to the low is completely broken again and then collect a nice profit to the downside. So all we're looking for is the market to pull up into a structure or pull down into a structure, give you some sideways movement, break that structure, give you a retest of the break, which was the first break was here, gave me a retest, rebroke the structure, created another high above this wick. We entered the trade, place your stops below the previous structure, and the market continues to rally up, and you take your profit at your next zone. And you just repeat that over and over again. So in order to find another entry, say you're looking to catch multiple entries on a trade, and you got your initial entry here, and then the market rallied up to this level, and the market actually opened here, pulled down to this level, and then rallied up again to complete the trade. So what you do here, actually, I don't even have to use this tool, but I'll just use it since I collected it. What you do here is you have previous resistance here to the left. As you see, once the market rallied up, it respected that previous resistance. The market then pulled down to test previous support to the left. Once that support was not broken to the downside and the candle has not closed to the downside of that support and rally back to break your resistance level again, you made your second entry. So you have one entry here at this level, another entry here at this level, and you made profits on both of those entries to the upside. As long as the market is not pushing through a level, finding resistance, pulling back, and creating a new low at market structure, it's not closing below the support level that it has created on previous structure to the left, then once the market pushes up again off of that level, you're safe to make another entry. Again, your stops are always placed a few pips below your previous support or your previous resistance areas. You place your stop losses below those areas, and then you just hold the trade to rally, or you hold the trade to decline. If your stop loss is hit below this area, then you know that the trade has went against you, and you don't chase that setup. If your stop loss is hit on that setup, then you just wait for the market to rally up to this level and give you another entry. Or you can wait till the market rally up to this level and give you another entry. It all depends on, how much you want to trade. But when it comes to trading, the least amount of trades that you take make you more profitable because you're waiting for great setups. You're waiting for the more profitable trades to set up on your charts in order to get a good risk to reward. Me, I look for 2 to 5 times my risk. So if I'm risking $100, I want to see, $200 or $500 in profit return on that risk. So all you're looking for is market structure in your price action zones to be touched, the market to consolidate and make you a channel at that level. You're waiting for that level to then be broken and the market to close below that level, or pull back and retest that level, and then for the market to break that level again. You enter, you place your stops, and then you wait till the market tells you otherwise to get out. Because like if you see here, the market did not come all the way down to the zone on this trade, but the market did come down to previous levels. The market created your channeling structure. Once the market broke out here, retested, and this candle closed, you were out of the trade. You got an entry here. Market came down, retested this previous support level to the left, broke that level, closed outside of that level. You exited the trade. The market rallied to the upside and continued to retest previous highs. So all you're doing is playing price action zones, and market structure. That's all you need to do to trade this strategy. You don't need any other indicators other than what price is doing at certain levels in the market, and you're using structure in order to make your entries and exits on those trades. It's as simple as that. If you use this strategy, how I just presented it right here, you'll up your profit percentage. You'll up your trading percentage. You already have 50% chance of winning or losing. So it's up to you as a trader to be patient enough to increase your odds to 75, 80, 90%. And this simple strategy will give you those odds if you trade it the right way. You consistently trade it this way. You don't deviate from how the strategy is created. As long as you trade these rules, you stick to these rules, you will make more profitable trades than losing ones. The strategy is simple to trade. It's easy to see how you can make good moves in the market trading this strategy. You can easily step down on a chart to find faster entries. So if we go down to the 4-hour chart here, you can realize faster entries on the 4-hour chart because it gave you a faster entry here, but then you see that the market rallied down here and it didn't give you a pullback for a long time. And then you found an entry again to this downside move, and then you maybe move here. But if you were on the daily chart, it would have gave you, a more clear entry on when to take this trade here. And instead of waiting for the market to rally all the way down here on the 4-hour chart and pull back here before you found an entry when the market broke this new low, the daily chart would have gave you a clearer picture of when to make that trade, because the daily chart would have already pulled down, retested your zone, and then broke to the downside. So it just depends on how you're willing to sit on this trade and how much patience you're willing to have. Me, I do make 4-hour entries, and I do make daily entries. It all depends on the setup, how much room I have for the market to move on that setup, and then I base my entries and exits off of that. So as long as you trade structure, price action zones, previous structure, break of structure, the close of a candle through structure, wait for the market to give you a pullback. Either you could have took this pullback here, which rallied all the way back up to previous market structure. Once this market has broken this low here, the market then traded for maybe a day, gave you your retest. This previous low here was broken to the right. You entered the trade. Market gave you a nice push to the downside. You exited the trade right here at your previous support price action zone. It's as simple as that. If you trade this strategy this way, you will see profits in the market. So you just take this video, you incorporate everything that you've learned from previous videos, you tie it all together, and you trade the strategy as I have presented here today, and you will increase your profitability. As long as you have the patience to trade this strategy, it will work for you. So thanks again for checking out this course. Thank you for becoming a student of this course. Take this knowledge, mold it onto your charts, follow the simple steps, follow the rules, stick to the rules in the trading plan, and you will be profitable. So that is the perfect entry and exit strategy. Thank you again for tuning in, and happy trading.